Hello again, everybody. Tom Olsaban from the University of Illinois Tax School, coming to you from my safe house, we'll call it, in Maryville, Illinois. We're not on the campus yet, back at Urbana-Champaign, and we're going to bring you this week's blog. The goal of this blog and several more coming after it will be to try to address questions that came up during the PPP loan forgiveness webinar that we did on Tuesday, May the 19th. By the way, that is available for video replay for those of you who maybe didn't get a chance to participate. We had a lot of people, over 800, so there were tons and tons of questions that there just wasn't time to get to in the space allotted during that broadcast. So I'm going to try to address some of the questions that I think were some of the most popular coming through. We've got a limited amount of time when we do these blogs. I hate to keep you folks on these videos for longer than 20 to 25 minutes, and we're going to run real close to 25 minutes today on this one, and we're going to address about 3 questions, so we'll go ahead and get started. If we can go ahead and pop up the first slide. So the questions that I'm going to address today deal with what happens if we got an economic, or our client got an economic injury disaster loan, referred to as an EIDL loan, and what is that impact on PPP, Paycheck Protection Program, loan forgiveness. The second question is, what happens if a company goes out of business after it gets a PPP loan? And thirdly, what we're going to spend the most time on is calculating full-time equivalent employees, FTEEs, and give you examples. So the first thing we need to do, if we can have the next slide please, is to talk about just a brief background about the PPP program. You know, the design of this program is to be a short-term cash infusion to keep businesses going, but most importantly, to keep people paid. That's the real key. I will tell you that in the late hours on Friday, May the 15th, the SBA released the forgiveness paperwork, including instructions. We've got a clickable link here for you in the video that'll take you directly to the paperwork. I think a lot of your questions will be addressed by flowing through the application and also some of the definitions and the steps that it uses there. I think it's very, very, very useful information, and we're glad to have it. Now, I will give you a caveat that any of the things I talk about today can change. There are a number of proposals out there in Congress to change it, and as soon as we know something about that, we'll get it as quickly as we can. I would strongly suggest you join our Facebook group. That's the quickest way to get the most current information. So I want to stress that to you sincerely as we go forward. But before we go into our first question, I want to give you a correction from the webinar that we did. There's a more full-blown correction that'll be coming in our webinar we do next week, so stay tuned. But here's what I want to talk about and where we had an error and I didn't discover it until today. We talk about the 75-25 rule in the SBA program, and we talked about it in the webinar. 75% of the PPP loan money is supposed to be used for payroll, the other 25% for other qualified expenses. Now, that being said, what we had said in the webinar, what I said in the webinar, was that if you use less than 75% of the loan amount for payroll, that's fine, but you can't use other qualified expenses to make up the difference to get you to 100% loan forgiveness. Well, that's not exactly correct. It is true that qualified expenses cannot be more than 25% of the loan amount, but get this. If the payroll portion doesn't end up being 75% of the borrowed amount, whatever that percentage of shortfall is going to reduce the amount of qualified expenses that are eligible for forgiveness, and is going to increase the amount that the borrower is going to have to pay back. So we want to keep that straight. I've got an example for you in the blog that'll be coming out next week, but I want you to be aware that yes, we can have the full amount of payroll forgiven, but if that doesn't end up being 75% of the loan amount, then the qualified expenses are going to be a lower quotient, and then there's going to be, again, more that has to be repaid. So let's keep that in mind as we go along. So we can go ahead and have slide 3. We're going to go ahead and get into our questions. The first one, again, deals with these EIDL loans, these economic injury disaster loans or grants, and what is their impact on PPP loan forgiveness. You can still apply for a PPP loan if the EIDL loan was obtained January 31st through April 3rd of 2020. If that EIDL loan was not used for payroll, it doesn't impact eligibility for a PPP. If it was used for payroll, then that idle loan's got to be refinanced into the PPP loan. Think about it. Payroll from idle comes to Paycheck Protection Program. Got to roll it into it. If the business also receives a PPP loan or refinances an idle into a PPP loan, we're going to have to subtract away that grant money that ends up being tax-free away from the amount that would be eligible, for forgiveness under the PPP program. So in other words, we can't have double dipping, and that makes sense. We also mentioned here on the slide that businesses can't use the idle money for exactly the same costs as PPP. We have an example here where if the idle money was used for a given number of employees, and not just a number, but given employees in the month of May, we can't use the PPP proceeds for those same employees in the month of May. Now, we could use it in the month of May for different employees, or we could use it in the month of April or June for those same employees, but not just the same employees in the same month. So if you want to know where to get more information about that, I've given you a PDF which you can go ahead and plug into Google, and it'll take you to the information that I just provided you. Let's go on to the second question, slide number 4. What happens if a company goes out of business after obtaining a PPP loan? Well, this question was asked during the webinar, and I thought it was a slam dunk answer because when you think about it, who's providing the guarantee? SBA. It says it doesn't require any collateral, nor does the borrower have to provide a personal guarantee. But be careful. I did some research out on the internet, and it took me to a number of legal sites, and here's what sometimes happens when an individual goes to their bank. So if you remember when the program first started, most lenders were saying, we're going to work with our customers first before we just work with the general public who maybe doesn't do business with the Bank of North America. Okay, that being said, I thought that was good customer service, but there may be something more at work. There's something attorneys have referred to called a dragnet clause. And here's what I want to mention. When that PPP loan is taken, and let's say that your client, the borrower, has other loans with that same institution, the dragnet clause could come in to say all of these loans, the regular borrowing they've had, plus this PPP loan with this Bank of North America, could be all considered one package, which means the collateral provided, the personal guarantees provided, could apply to all of the borrowing, including the PPP loan. We have no idea when we sign this REMA paperwork when we go in the bank, but be careful in the event that you've got a client who goes out of business and say, well, at least I don't have to be worried about them coming after my house for that PPP money. They may want to double check with the bank at that time. It may not be the case. So the moral of the story I mentioned down here at the bottom, it's kind of talking about the horse after it's out of the barn, but did it make sense to get that PPP loan with the same friendly neighborhood bank that we do our other business or borrowing with? Well, a little late now, and we may not have had much choice, but the moral of the story might have been no. It made it sense to go through a different borrower, but I don't know how we're going to deal with that since it's already happened. But I want you to be aware of this circumstance should it happen. I'm not saying that the banks did something sinister, although I hope they would have explained it. That it could be like, I think the term the banks like to use is cross-collateralized, but anyway, we're going to go ahead and move on. Now we're going to spend the rest of our time talking about the issue with full-time equivalent employees, FTEEs, and how the change in employment could cause less loan forgiveness, meaning more that has to be paid back. Remember, the goal of the PPP program is to keep people employed, give a quick shot in the arm money, and that way to keep the business going, but the government want that money spent quickly. You're going to hear me use 8 weeks and 56 days a number of times. Now, as we begin this section, let me say this to you. If you're dealing with a client who went ahead and got a PPP loan and they're just business as usual, no change in employees, no change in payroll, you don't have to go through all these calculations. You know, if they used enough of it for payroll, enough of it for qualified expenses, yes, we're trying to get to where, could we get to 100% loan forgiveness? Yes. But what we're getting into here is where either the number of employees was reduced and not restored in a certain period of time, or the payroll has been reduced, and that's where we could have the loan forgiveness reduced. Okay, so we'll move on to the next slide. And then a lot of this information is going to come, like I mentioned, right out of that SBA paperwork, that PPP loan forgiveness form, and the instructions that came with it. So the first thing we talk about after you put their name down is they want you to list the cash compensation, and I think it's important, you might want to circle this, the gross salary. There were some discussions about whether or not we use gross or net pay. We use gross, and this is going to be for W-2 employees. Okay, and we talk about listing that for a couple of terms that I'm going to define coming up: covered period and alternative payroll covered period. So we'll get into that in just a minute, I promise. But I also want to mention that for any one employee, you don't include more than $100,000 on an annualized basis per employee, not total of employees, but per employee. For this covered period, which I'll define in a minute, how do we come up with a number? Take $100,000. I know there'd be no math, right? Take $100,000 divided by 52, multiply by 8. This kind of factor is going to be used often. I don't want you to divide by 12 and multiply by 2. I want you to divide by 52 and multiply by 8. If you take $100,000 divided by 52 and multiply it by 8, I bet there's some of you doing that right now, you're going to get what? $15,385. That's the most we can show for any one employee. I will tell you that it can be increased, that $15,385, for payments during the covered period for health insurance and retirement plans and things like state unemployment. But we'll get into that as we go along. Okay, on the next slide, we're going to define these to you. That covered period is the 8 weeks, and now the loan paperwork from SBA says 56 days. So that may answer your question to ask, are these business days or are they physical 7 days in a week? They are 7 days in a week. So 56 days from the day they got their money equals the covered period. And we have an example here that there's a loan proceed distributed on April 20th. That's day 1. The question came up during the webinar, is the first day day 0 or day 1? It's day 1. That gives them until June 14th. That's day 56. To spend these funds if they're looking for loan forgiveness and in fact have part of it forgiven. So we had the question about, is day 1 0 or day 1 1? It's 1. The other question that came up during the webinar was, what if a taxpayer, a borrower, leaves the bank with a check, walks around with it in their pocket for 3 weeks? Is it when they deposit it to the bank? I'll tell you, don't let your clients play that game. They were in constructive receipt of the money. The fact that they chose not to deposit it means nothing to the bank. The bank's going to go with the date on the check. So that's going to be day 1. Okay, so that's our covered period. If we can have the next slide, please. We have an alternative payroll cover period. And all that does is address that if we got the loan this day and payroll isn't for a week, could we use a later date? The answer is yes. In the example here, which builds on the example we just did, the loan proceeds were distributed on April 20th. The following Sunday, April 26th, was the next payroll period. The taxpayer can choose that alternative payroll covered period starting then April 26th, which would give them till Saturday, June the 20th. And we use the acronym APCP. And now throughout the SBA PPP loan paperwork, the borrower will be asked to check a box which says we're using the alternative payroll covered period. So I think it's important to be aware of that as well. So then what we have to do in the next slide is we have to calculate the average FTEEs. So in doing that, we have to look at what's an FTE. Well, the FTEs are 40 hours. One FTE is 40 hours. Well, a lot of people work less than 40 hours. So in the first calculation, you take 40 hours divided by the hours they really worked, and that gives you what percentage of an FTE you have. That sounds kind of crazy. There's actually a simplified method which says if somebody works 40 hours or more a week, they're 1. If they work less than 40 hours, they are a half. There's no additional credit given regardless, by the way. If somebody works more than 40 hours a week, like 60 hours like you and I do, that doesn't give them 1.5. That's still a 1. Everybody below 40 is a half. I would use the simplified method. I think that would be important to consider. Also, too, I want to mention that when we're talking about this 40 hours, the paperwork from SBA says 40 hours. I mentioned that during the webinar. Had some questions come back which say, I beg to differ, because some companies, some businesses will use 30 or 35 hours as defining full-time employment. Hey, you're welcome to it. Look at the paperwork from SBA. They use 40. We have to use 40. So that's important as well. If we go on to the next slide, then when we talk about what's going to happen, why are we doing this? Remember again that the purpose of the program is to keep people employed. So if the numbers of employees, and by the way, this doesn't matter who they are, what their names are, or any of that, if the number of full-time equivalents drops, then by that amount that it dropped, we're going to have that much less eligible for forgiveness. And I'll describe that when I get to that in just a minute. And there are, in fact, some safe harbors that we'll talk about as well. The next slide, we have to talk about a test period. What do we have to do to compare what our full-time equivalent employees are now to what they were before? You have one of three choices. You can use February 15th, 2019 to June the 30th of 2019. You could use January 1st of 2020 to February 29th, 2020. Or the third choice, if we have seasonal employers, you could use either of what we just described, or a consecutive 12 weeks between May 1st of 2019 and September 15th, 2019. Here's my advice for you with your clients. Use the method that ends up with the least amount of FTEEs. We want the lowest number, the smallest number of FTEEs to compare against what we're doing now. Okay? Now, what's the moral of that? If we end up with the same number of employees or more, you're gold. You're good to go. If you have less employees than you did in the test period, the percentage by which we've decreased is the percentage of PPP loan proceeds that can't be forgiven. And I have an example here for you. In the test period, you had 10 FTEEs, and now you have 9. That's a reduction of 10%. Therefore, 10% of the PPP loan proceeds are now not eligible for forgiveness. See this? The idea being to keep people employed. Now, there is a safe harbor I'll talk about here on the next slide. We can be exempt from the reduction in loan forgiveness if we meet both of these conditions. The borrower had to reduce its level of employees between February 15th and April 26th, the worst time for the coronavirus situation so far, when it really started hitting and people started shutting down and hunkering down in place and all of that. So they had to lay people off during that period of time. And two, they get that employment number restored by June 30th, and then you can ignore that layoff period between February 15th and February 15th and April 26th. And it doesn't have to be the same employees. We're just talking about employee numbers. It doesn't have to be the same people. So that's the safe harbor there. Okay, so let's go ahead and take a look at this example we've got. And I say, in addition to yourself, and there's going to be some planning in here, yourself, you're the sole proprietor we're talking about. There are 3 employees. They made $3,000 a month. So the PPP loan amount was $22,500, which the average over the last 12 months, $3,000 a month times 2.5, gave us the $22,500. Remember, there's 3 employees, so we had $9,000 times 2.5. Had to lay them off in February. Only 2 of 3 employees were able to be hired back, or 2 out of 3 were hired. That's only 2/3 during this test period. And by the way, the owner is not considered in this test as an FTEE. I think that's an important consideration as well. So let's go on to the next slide. So over that 8 weeks, the covered period of 56 days, $12,000 was spent on payroll for the employees. And you know what? That didn't get us to 75% of the loan amount. So we advised the owner to take payroll, to take a draw of $4,875, with the remaining funds being spent on other qualified expenses. So our payroll cost for that time ended up being $16,875, which is 75% of the PPP loan amount. Remember, we have an issue here if we don't hit that 75% benchmark. Qualified expenses outside of payroll, those would be things like mortgage interest and rents and utilities. They are limited to 25% of the loan amount. 25% of $22,500 is $56.25, just as you're seeing in the slide. Hey, looks like we're good to go. $22,500 is eligible for forgiveness, tentatively. $16,875 for payroll, plus $56.25 for other qualified expenses. Uh-oh, but we only brought back 2 of the 3 employees we had numbers in the test period. So only 67%. We only got back 2/3. So 67% of the loan is eligible, which means $15,075 is all that is eligible. $7,425 will need to be paid back. And remember, if I didn't mention it before or you didn't have a chance to participate in the webinar, the interest rate is at 1%. It accrues from day one, when the money is dispersed. Loan repayment begins after 6 months and has to be paid off over 2 years. So keep that in mind as well. So see the reduction in FTEEs? Hey, we spent the money, but we had a reduction in the number of employees. That's an important consideration. So there's a second test, the salary or hourly wage reduction. This calculation is used to determine whether the borrower's loan forgiveness also must be reduced because individual payroll circumstances dropped by more than 25%. That's the key. That's the key. Let's go ahead and move on. Now there's a worksheet that the borrower needs to go through from the PPP loan forgiveness website or the link that we gave you. And we have to complete that for any of the employees where it dropped greater than 25%. If it didn't drop by more than 25%, there's a safe harbor there. There's another safe harbor if we can go on to the next slide. This will be slide number 18. We have a circumstance with the FTEEs that if the borrower can document that they offered for the employee to come back and the employee said, no, I'm doing better on unemployment, I'm not coming back to work for you, we could leave that employee out, or that individual was fired for cause, voluntarily resigned, or voluntarily requested and received a reduction in pay, or their hours, sounds like we need to have that documented. In all those cases, we can use those exceptions, so we're not looking at the individual employee, but we can only use it if the employees were replaced. If we didn't do it, then the safe harbor doesn't apply. So let's go on with an example. We're on then slide 19. We have those same 3 employees from our example who made $3,000 a month. So the PPP loan amount was $22,500. They were laid off in February. They were all hired back. We really needed them, but the borrower could only afford to pay them $2,000 a month. Remember that the first thing we have to do is to see if payroll was reduced by more than 25%. In this example, payroll for each employee was reduced by 1/3. So then we start to go through the calculation. This next slide is actually the worksheet, or from the worksheet, I should say, from the PPP loan forgiveness application, which basically refers to the slide I just did. When we divide what the annualized payroll is for these employees now, for each employee, $24,000. What was it before? $36,000. There we see that it is 2/3, 67%. So it is less than 75%. We have to go on to the next step. So in the next step, we have to see, is a safe harbor met? Well, we don't meet the safe harbor because the payroll is less than 75% than it was in the test period. So we can go on then, and we have to do a wage reduction test on slide number 22. So we look at what our wages were before, $36,000, take 75% of that. You know where that came from. See, that's kind of the reciprocal of what we just talked about. We look at, did they drop more than 25% by saying, are the wages totally 75%? So 75% is 27. You can see it there on slide number 22. Then we subtract that from what we're paying them now, which is 24 on an annual basis. That's $3,000. Okay? You can skip the rest of these unless you're doing hourly employees. But then you go over to slide 23, and then say we take that difference, 3,000, multiply it by 8. That gives us 24,000. Then divide that by 52. So here you don't divide by 12, or divide by 12 months. That gives us 462. That's a $462 reduction per employee that we'll have to do for each one of them. So let's see what we have here in our narrative on slide number 24. So over the 8 weeks, the 56 days of the PPP period, $12,000 was spent on employee payroll, plus we advised the owner, hey, take $4,875 for yourself, so we get up to 75%. The non-payroll expenses were still limited to 25%. So the full 22.5 again appears to be eligible for forgiveness. Well, guess what? It's impacted by that reduction, though, in those employees' compensation, not the owner's compensation, but those full-time employees. That 75% test, if you just did simple math, looks like it would have come out to about $500 in reduction for each employee if you just divided by 12 and multiplied by 2. But by using the divided by 52, we had that 462 reduction. We got to do that for 3 employees. So we have a reduction of 1386. So instead of 22.5 being eligible for forgiveness, as you see on slide 24, it's 21,114. Again, the goal is to keep employees employed. In our last slide, number 25, I mentioned the impact of safe harbors and reduction exceptions. Did we get payroll back up to speed by June 30th? Can we use that safe harbor? Do we have employees who refuse to come back? We didn't get them replaced. And finally, don't forget to tell your client, the owner, to pay themselves. I'm assuming that we're talking about a non-incorporated situation, because if we have employee W-2 shareholder employees, they're employees just like everybody else. They would be an FTEE. But in the self-employed world on a Schedule C or a Schedule F, that owner would not be an employee. Should we tell them to take money to get us up to that 75%? Or we could have our qualified expenses reduced as well by the ratio by which we did not hit the 75%. So there's lots of questions. Like I've encouraged you, please join the Facebook group. Post your questions out there as we see changes. Lots and lots of more legislation is proposed out there. So we'll try to get you that information as quickly as possible and as timely as we can. We'll have another blog next week with some more questions. So for now, this is Tom O'Saban for all of us at the University of Illinois Tax School. We'll say goodbye for just a while.